we're getting to the end of what is a dollar dominant era. We know that de-dollarization is occurring around the world. A lot of the central banks are flocking to gold as a high quality liquid asset, but they're also planning the next currency, which will be central bank digital currencies. So we're about to go through this big transition period of the old system and the old Bretton Woods type system and then the new system.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. The markets seem to melt up every single day. We're just in a perpetual risk-on environment, and nothing seems to be able to slow this train down. Yet the banks are on shaky ground due to the expiration of the Bank Term Funding Program and the incoming commercial real estate crisis. The lower 60% of consumers are struggling to make ends meet, and unemployment is beginning to pick up. Gold seems to have begun a new bull run and has sustained a price over $2,000 per ounce for more than 14 weeks now. Will the ridiculous debt and deficit levels begin to tear down King Dollar? To discuss all of this and more, we're fortunate to have with us Rob Kientz, owner of Gold Silver Pros Bullion Store. Rob has over 20 years of investment experience in the bond, stock, real estate, commodities, Forex, and precious metals markets, and is a highly sought-after speaker at conferences and other events. He emphasizes long-term cycle investing in the precious metals markets. His research and weekly educative videos on YouTube focus on precious metals analysis, economic forecasts, and macroeconomics. And Rob is a strong advocate for sound money and believes that precious metals will help you safeguard your wealth and attain financial freedom. Rob, thank you so much for joining us today.
Thanks for having me on. I appreciate it.
Yeah. All right, let's begin with the markets and the economy. What's your current 10,000-foot view of the state of the markets and the economy? And are you expecting a total soft landing, or will there be a hard landing after the long and variable lags have completed their work?
I think that we're in a generational cycle. So I do a lot of long-term cycle analysis. And I think we're at the culmination of both an 80-year quantitative wave cycle as well as a 250-year nation-state cycle. Going back to Sir John Glovett, did this research in 1970. He went back almost 3,000 years and looked at all the primary civilizations, meaning the dominant ones of their time, such as Rome and Spain and England and the ancient Assyrians and so on and so forth. And he noticed that each nation-state had its own life cycle, had its own milestones. But then you could put those like on a transparency or on a map and lay them over each other for each of the dominant civilizations. So it seems as though history does repeat itself, although it does look a little bit different at times when it does. The general series of events seems to be very similar. So I think we're at the culmination of a couple of different cycles. And so I think, the famous phrase, this time will be different. I think this time is different. We're getting to the end of what is a dollar dominant era. We know that de-dollarization is occurring around the world. A lot of the central banks are flocking to gold as a high quality liquid asset, but they're also planning the next currency, which will be central bank digital currencies. So we're about to go through this big transition period of the old system and the old Bretton Woods type system and then the new system. Or you could say post Bretton Woods if you wanted to talk about getting into non-gold backed fiat currencies. First time, in history, the entire world's been on that system. But in any case, we're at the end of that old post World War II system, that old post World War II boom. We're not going to have that anymore. We're now in a system which is similar to most other nation states, by the way, that have come along this path, is we had, the best of times, and that led to us living beyond our means and racking up a bunch of debt and debasing our currency. And now we're in the times where we're going to start to pay for that a little bit, And so we're going to have some markets come down and some markets go up. But more than that, we're going to have currency regime change, which is going to be very interesting to watch because we haven't had that in a very long time. Especially here in the United States, we've all been living under this wonderful system in which we could print the dollar and it created all these advantages, and we could export inflation, which means our lifestyle was nicer than everybody else's lifestyle around the world. They were dealing with our inflation, but now that inflation is starting to come back and circle back around to the United States. So now we're kind of taking a dose of our own medicine, so to speak, and that's going to create a lot of turbulence, I think, specifically in 2024.
So it's interesting that you kind of finished that little part on inflation, because I was going to ask you about your inflation outlook. It sounds to me like you believe that inflation is going to stay higher. I don't want to put words in your mouth, but I want to ask you, do you expect the resurgence to look something and resemble more like the 1970s and 40s, where it's going to be waves and protracted for a decade, or how do you see that?
Well, I think it'll be slightly different because, again, back in the 70s, eventually Paul Volcker raised interest rates and kind of quashed it with the central bank. You can't do that now. If you raised it to 18%, it would be the death of the system. In fact, some people believe that 5% is the magic number. Some people believe it's 4 or 6, whatever. But you can't do that with as much debt as we have outstanding. You try to raise that interest rate that high, you're in big trouble. Right. As regards to the inflation, that is the popular theory. I've talked about it a lot. That in the 70s to 80, we had 3 waves of inflation and deflation, but each subsequent inflation wave got higher. So you had an inflation wave and then a deflation, a bigger wave, and then you had the blow off top. It certainly could look something like that. And I do notice by the data that we are moving back to inflation from slight deflation from a year previous. So it does look like we're going through waves. Now, whether or not we'll have that same 3-way pattern, I don't know. But I do think that we're going to culminate with very high inflation because we have so much debt. And with the rest of the world not wanting our debt anymore, there's either a debt default or an inflation. I think the government's going to go the way of inflation. So I expect to have at some point much, much higher inflation than we have right now. I would say right now is a little bit of a lull, even though that inflation is being felt by people, and it is real. And I think it's higher than the government numbers indicate. I think that's pretty obvious for the person that goes to the grocery store, buys a vehicle, or pays a gas bill. But in any case, this is a little bit of lull. It can get a lot worse from here. And I don't want people to be surprised. If it does, I certainly think that it can.
So what does your analysis say will be the economic and banking impact of the higher for longer interest rates and the current debt levels? And what do you see happening if the Federal Reserve accelerates its bond sales to cool the economy?
Yeah, the Fed is stuck in a tough position. If you look at what happened last year, we had the 3 big bank failures: SVB, First Republic, Silvergate, whatever the banks, whatever the banks were. And those were the second, third, and fourth largest failures after the one that occurred during the Great Recession. So those definitely were like warning shots across the bow. The Fed and the government put out the bank term funding program, which allowed the banks to put up collateral and get liquidity, get cash. And they could put whatever collateral they wanted. So in other words, it was a non-mark-to-market type of deal. It wasn't like you're going to the market with your debt and saying, let's refinance this. They went to the government, and the government said, we don't care what the debt looks like, we'll give you money. Well, that expires on March 11th, which, by the way, is today. And so from today, at the day that we're recording this, there's about a year for these banks to pay it back, but they can draw no more. And I think that's one of the reasons why gold's hitting an all-time high last week and now today at 2175, 2178, is because the gold market understands, and certainly the bond market understands, that the sort of punch bowl that we had last year to assuage the issues that we had in the banking system has been taken away. If you look at recently, is it New York Community Bank, which is tanking, and it's certainly not the biggest, but it's indicative of, I think, another wave of bank failures that are coming. And we're going to continue to have bank failures while U.S. bonds are devalued, and they're devalued by higher interest rates. When the interest rates go up, it devalues the face value of the bonds. Well, a lot of banks are holding on to a lot of these bonds. A lot of pension funds, a lot of other investments are holding on to these. And when their valuations go down, it causes balance sheet problems, and it causes problems in our current system since it's a debt-based system. Not everybody's running around with cash all the time or hard assets, some sort of hard thing that they can sell. A lot of times it's balance sheet risk. And the balance sheet risk is when interest rates go up, it devalues your debt asset holdings. And that's the dark side of the debt system, is when interest rate goes up, debt becomes debt again. It's not money. Right. Because when interest rates go up, you can't trade your old debt for new. See, in the old system, if you had good servicing debt, you could put that up as collateral for money. You could do it through the repo market. The bank term funding program is something that we did last year. But you could do it in the open market, or you could refinance. Well, now you can't do that. With rising interest rates, that old debt's not as valuable as new debt, which is going to get that higher coupon. So it's causing problems. So I think that we're going to have a raft of bank failures coming up. I think it's going to make it hard for the Fed in that environment. They're going to want to cut. The problem is we just talked about that inflation monster looming. Yeah. And if you cut, you're going to increase pressure on inflation because you're going to add more money to the economy when we've already added an historic amount since the pandemic in 2020. So I think whatever the Fed does could make the problem actually worse than if they just stood by and did nothing. But that's heresy to the market, because the market worships at the altar of the Fed.
Right.
The money trough has become the new religion in capitalist society in America. And if the Fed is putting out easy policy, the market likes you. If the Fed's tightening policy, the market doesn't like you. And so the Fed is under tremendous political and capital pressure to do certain things. And I think it's going to cause them to act, but the way that they act may not actually be in the best interest of the economy because of these different political pressures.
So do you view the stock market as being in a bubble? And if so, how bad will the stock market bubble burst this time? And is there a time period back, maybe 73 to 75 or another time frame that you would compare this time to?
Yeah, it's obviously in a bubble. If you look at P&E, price to earnings, they got to like all-time highs within the last year to 2 years. We're reaching all-time highs in the stock market, but for what we're making back from it, it's too high of a valuation historically. And when you look at historical analysis, I think there was historical analysis going back a couple hundred years of market data, almost a couple hundred years, about 150 years, 1871, I believe. Whenever you have this overvaluation of the stock market, it corrects. And not only is it, when it gets to past what we call four sigma, or 4 standard deviations away from the mean, is when it starts to crash, and it gets into that fifth is when it starts to crash down. And when it crashes down below what a normal valuation would be, and goes undervalued, but that process takes a long time. So yeah, I do think that we're in huge bubbles in the stock market, the real estate market. There's been too much money printing. If I thought that everybody was going to use the dollar and hadn't publicly said we're getting rid of the dollar, then I say maybe we have another round of this, and maybe we're okay. But with the world de-dollarizing, what's going to happen is that market's going to crash hard because you don't have the demand for the dollars. And what drives up the stock, bond, and real estate markets? It's excess liquidity in the system. It's excess liquidity that bids up those risk assets. So in other words, in this type of system, the risk assets, the paper assets, if you will, get bid up with the more money that you have. When that money system turns around, it starts to shrink, which it is now. Then those valuations have to come down, and they can be quite nasty at times when they do. So I do think when we get the next correction, it's going to be, like I said, a long-term cycle correction, an 80 and a 250 year. And also you have to look at the currency situation. So it's going to be a currency change all going on at the same time. So I think that we could have pretty big slams,
How deep do you think it can go?
I don't know, because, there's something called, fractal analysis, or if you look at math, the way math works, when you get to large numbers, is not linear like it is at smaller valuations. You start to get into exponential functions. And so this could be an exponent of previous crashes, or it could be its all new crash. It could be something different, because think about some of the characteristics are different. All world currencies are pure fiat at the same time, more debt than any time in history. As a world economy, new systems coming online, new geopolitical tensions, changes going on in the commodities complex and the trading routes and things like that. The whole world is changing underneath. So the fundamentals are changing. So because the fundamentals are changing more this time than say in 2008 or 2000, or even, during the Great Depression, fundamentals of the world are changing so much that this time could look different in terms of what that looks like. But just know that it's not linear. So people should get out of their heads, well, it did this in 1980, it's going to do this now. Well, not necessarily. Yeah. It could be much bigger. It could be much smaller. This time, I think the fundamentals are pointing to a bigger move. But I don't want to call numbers, because at this point, it doesn't really matter. At the end of the day, as an investor, you basically have one rule: don't lose money. So it doesn't matter whether it's a 40% correction, a 60%, an 88, 350. It doesn't matter. What matters is you don't live through that correction with your money in the market, because if you lose money, then all the effort that you had to build up some sort of portfolio or wealth plan is basically gone. So you want to avoid those losses. So when you see the peak coming, you want to turn around and maybe think about what your asset mix is going to be. And it doesn't matter as much if, it's kind of, the saying is, I'd rather be 2 years early than 5 minutes too late, because if you're 5 minutes too late, you're too late. Yeah. So, certainly you want to make preparations ahead of time if you feel like this is something that's going to happen, and you just want to stay out of the way of that tsunami when it comes, no matter how big it is. It doesn't really matter. You don't want to be in an earthquake, right? You don't want to be in a tornado. Just steer away from that.
So those, those who lived through the great financial crisis, the .com crash, they experienced massive drawdowns in their portfolio, so they can appreciate what you just said. So Rob, if the stock market does crash, does, mean revert, as you're talking about, what do you see happening with pension funds, and how do you see the Fed reacting here?
Well, pensions are basically bankrupt. All the good assets have been taken out of the pensions. There's a lot of paper bubble assets in them. Those kind of assets tend to have the biggest crash when we do have a crash. So whenever the next crash comes, the pensions, for all intents and purposes, are broke because not only will the asset valuations come down quite a bit, but in addition, the amount of money now paying into those pensions is not as much as is coming out. It's the demographic problem that you have with the baby boomers, a large generation, the last generation really to have pensions, or at least widespread pensions. A few people still have them, but it's minor. Most people have more like a defined contribution plans instead of defined benefit plans. But the pension being a defined benefit plan, you got to pay out those benefits unless people are paying in. And at the same time, the market is retreating. So I don't think that there's a lot of value left in the pensions personally. I had a very small pension with EY a few years ago when I was in consulting, and I cashed out as soon as I left the company because I was like, there's no way that they're going to pay this out. And it wasn't big enough for me to live on anyway. It was just a block of money. So I took the penalty, filled out my tax forms and took the pension. For people that are, that have longer term pensions or 401ks, I'm not your financial advisor. I can't tell you what to do, but you may want to start looking at risk scenarios and try to determine, okay, does it make sense for me to leave money in these assets? If these are risk assets and they're going to come down, and we also know the demographic problem supporting a lot of these markets is going to start to flip, the biggest wealth transfer is coming. And that wealth transfer is going to come from the older generations to the new. And depending upon how these older generations are positioned, though, that wealth transfer, a lot of that could be evaporated. I think Kiplinger's had a study a couple of years ago that says it's going to be 64 trillion, but it won't be 64 trillion if the stock market crashes. It could be 30 trillion or 15 trillion. So if you're certainly waiting on that wealth to come down to you, it depends on what that wealth is parked in. So we're going to have to see. It's going to be interesting times the next few years to see what happens.
Interesting. So you recently wrote that liquidity problems coming soon in the debt markets as the repo market dips below 500 billion, that banks will have to tighten lending standards as a result. So expect a market lockup sometime this year, forcing the Fed to intervene, sending bond rates much higher. Will you speak into that a little bit more for us?
Yeah, so the repo market came to light during the great financial crisis. When analysts went back to the great financial crisis years later and examined it, they noticed that the repo market locked up first, and then that was an indicator that the rest of the debt markets were locking up. And without getting too much into detail, repurchase market is basically an overnight funding market where high quality, very short-term assets are put up, and you can lend those out and earn interest on them from people that want the debt, and you get the cash back. So if you've got that kind of debt and you're needing cash to overnight finance your business and you don't want to go to the Fed window, or you don't have other lines of liquidity as a short-term loan, a lot of people go to the repurchase market or the repo market. So that market in a debt-based system is the marginal liquidity market for the system. And by that, I mean, it exists at the margins to finance the economy above and beyond, the rest of the currency circulating in the system. It's a very quick overnight market, and it's something that people have become to rely on for income. The problem is that liquidity is drying up. At one point, we had 1.5 or 6 trillion. I forget the number. Now we're down to 500 billion. And that's a warning sign. Once it went under a trillion, economic analysts started talking about this could be an issue, because that is also, if you think about mathematics, that's an exponential market too. It needs to be bigger than before because we have more debt. We have more money sloshing around. So the numbers in repo have to be bigger than last time. And they're already reaching thresholds that we would, under normal circumstances, consider a problem. In a nutshell, if the liquidity doesn't come back to the market, and I don't see it doing that because of interest rates. Interest rates got too high. People did not want to borrow in that market because once you get over 5%, they don't want to pay 5%. They'll find other means of transacting. But the problem is there's not a lot of short-term liquidity outside that market. It's drying up. And so once that repo market freezes, it causes problems in the overnight or the intraday funding markets, and it can cause the system to lock up. Now, the Fed has been intervening in that market, but they've been intervening less lately. And if they're going to end up being the liquidity provider of last resort, but if they allow that repo market to get drawn down and there's not enough liquidity in the system, it locks up and we have another Lehman event. This time, however, more banks, I believe, are in trouble. If you look at the FDIC's website and how many banks are in trouble already, when this repo market dries up, we're going to have more bank failures than we did in 2008 or last spring. And it's definitely—
So that's what you're seeing coming.
That's what I'm seeing coming, and it could happen this year or next year. But I think the Fed and FDIC will intervene again, but I don't see how they stop it this time. I mean, to me, that's a runaway freight train.
Interesting. So, Rob, what's your take on the exploding deficits and large debts of the U.S. and how it pertains to the currency, the U.S. dollar, and how the rest of the world seems to be de-dollarizing, as you said? In other words, what do you see for the U.S. dollar over the next 1 to 5 years? What do you see for purchasing power? And what do you see for the impacts on the markets and where investors will be putting their money for both appreciation and for protection?
Yeah, so essentially, the debt market is the dollar market, and we're at the end of that market where we have a lot of debts. We have a lot of dollars slushing around, but that's caused excess inflation all over the world. And what's happening is other central banks in other countries realize that risk, so they're designing a new system. It's a central bank digital currency system. It's going to have some gold backing. I gave a lecture at PDAC about last weekend about how this is likely to occur. I drew a lot of information from the BIS's website, IMF's website, friends I have, in the space. But essentially the new system is coming, and they know the old system is coming back. It's coming apart. And right now, the dollar index is under a little bit of pressure because the world's de-dollarizing. There was a study by the World Gold Council in 2023, and they interviewed the world central banks and said, what are dollar reserves going to look like held around the world? Meaning, is the dollar still going to be the unit of trade for the world? And they said, well, it was at 59% at the time that survey was taken last June. Now it's at 58. All-time lows, by the way. We're already at all-time lows of the dollar being held by other central banks for trade.
Yeah.
So anyway, they said, no, it's going to come down to 40 to 50. Well, once it comes under 50, technically, you're not the reserve currency anymore because other currencies are now being held more. You may have a plurality, but you're not the dominant currency. So we're already in the beginning of the end of the dollar phase. And so as that dollar system comes down, the interesting thing is going to be to see what replaces it. Gold will do very well. A lot of dollar-based investments are investments that depend on a strong dollar will not do well. Things that hold value when currencies get in trouble will do well. Precious metals, certain businesses, income-producing land or farmland, those types of things are the things that I would see. I think I answered your question, though. You had a couple of parts to it. Anything I didn't answer there?
Yeah, you totally did. But let's shift over to the consumer. Excuse me. You recently wrote that the public is dumping en masse their gold and silver in my store.
Yeah.
That I've purchased entire estate sales many times over. All the gold necklaces in Texas now belong to me. More junk silver than I realized possibly existed. The middle class is just dead broke. The economic crash is here right now. So I know some of that is satirical, but will you speak into what you're seeing for real?
Yeah, last year I decided I'd represented other companies for a long time in the gold space, being a social media guy, but I decided to kind of put my money where my mouth is and open my own stores. Now I have my own bullion dealer here in North Texas, in connections with several wholesalers. So, I do a lot in the market, from high net worth people to just everyday people want to come in and explore, buying some gold and silver. We do collectibles and jewelry, and we kind of have that full service business. And what we're seeing is, and the reason I got in jewelry in the first place is because people were selling it. Originally I was just going to be a bullion dealer, but there's so much jewelry being sold back to me. I'm like, okay, I have to become a jewelry dealer. It's like, you have no choice at some point. Yeah, but what's happening is people are shedding their wealth. And I had a lady come in to me. The interesting thing was, I lived in a neighboring town for a long time. She had owned the land that my house had been built upon before it had been built, before the city was incorporated. She's been around a long time. She was in her 90s. And she came in and sold me a bunch of her precious metals. And we were getting talking. I was like, well, why are you selling your precious metals? She said, well, this is my retirement. And she said, I'm out of the rest of my assets. Her husband had died many years ago. She had, this is how she lived. And she's selling her assets. She said, this is the last stuff I got, so it's got to last, And she was selling her heirloom silverware that was in her family because she had nothing else. And precious metals are often the last thing that people sell at the end of the day when they have no money. But that was one example. I have people coming in saying, I want to go to nursing school, and here's my gold necklace to pay for nursing school because loans don't cover it, and I need to cover the gap. I have people coming in telling me I'm not going to make my rent if I, don't sell my silver or gold necklace. And some stackers who had been, stacking gold and silver got into trouble with inflation. Not their fault, but they're fully knowledgeable of the situation. But even them, that they're coming in to sell. So we've had more people selling back to us than we've been selling to the public. So the supply chain is reversed. That's good for people who are buying gold and silver because it brings down premiums. Excess supply means lower premium, lower prices. But it's an indication that the public is suffering. And I hear more stories on an everyday basis about how people are not able to make ends meet than I can remember even leading up to the 2008 crisis. This is going to be a very deep economic cycle, I think, if this type of information and this type of feedback is any indication. The middle class is really suffering problems. And it just seems like that's going to continue until some resolution happens in the economy. And I don't see the government being able to offer, being able to kick that can down the road anymore this time. I think this time is different from the aspect of whatever conclusion we're going to come to in this economic cycle, it's going to happen.
It's interesting. All right. So the baby boomers are celebrating their 60 to 78-year-old birthdays this year. They're retiring about 10,000 a day. Yes. These retirees will soon have to dump assets such as stocks and houses to pay for their health care and other retirement expenses while they're living on fixed incomes. They must also sell stocks out of their 401ks through mandatory minimum distributions. So, Rob, in your analysis, what impact will all of this selling have on equities and housing prices?
Well, it's going to reduce them, of course. One thing that's keeping up prices like here in Texas is immigration, either from our country or from other countries. We have so many people coming in from other states or from South America, Middle East, whatever the case may be, that Texas has a real estate boom. In fact, it's bubbled. I've never seen a bubble like this in Texas. This bubble is a bit more sustainable because of the demand. But the problem is, you're right, as this big population center within U.S. life begins to need those funds, they begin to reverse fund flows from into these assets from their employment, from out of these assets into their retirement. It's going to cause excess supply. And I don't even think the immigration we have now is going to be able to make up for that. Plus, different areas of the countries are in different scenarios. There's a net migration out of places like California, New York, other places like that. So I think you'll see prices crash down further. But yeah, the baby boomers hold 50% of all the wealth in the United States.
It's amazing.
The millennials per capita, per person, are the poorest generation as of right now that's basically existed since we've been keeping these statistics. And so there's a huge wealth disparity. And yes, some will flow back down to the millennials, as these come through estates and wills. But the valuations of these assets are going to come down. It's not going to be quite as robust as people think. And I think these asset prices have to come down. The demand is simply, it's not there. And the population demographics, there aren't going to be enough people with the wherewithal, the ability to maintain these assets. Because if you own a home, you got to fix it, you got to insure it, you got to keep
Property
up with
taxes.
Yeah, taxes, all that kind of stuff. How are you going to be able to do that if you don't have the income and we're going through a major recession? So I think a lot of these things are going to kind of come to fruition at the same time. Demographics is going to be a big factor in what does well in the next cycle. And when you're dumping all this real estate and all these bonds and all these stocks, we're going to have a negative cycle in those assets for sure.
All right, so let's talk about unemployment. Excuse me. Rob, the current administration adjusted down January payrolls by over 100,000. Mm-hmm. This is something like the 10th or 11th straight time out of the last 12 months. I don't know. I've lost count how many times they keep revising it downward. Do they have bad information? Are they intentionally lying as they continually revise these job numbers downward months later and under the radar? What's going on here with these numbers?
Well, when I wrote my book in 2009, chapter 2 is 50 pages, and I used that chapter to examine the government numbers over CPI, inflation, all sorts of things, interest rates, just 5 or 6 key data points that matter to everyday people, employment, stuff like that. And, I looked at it and I said, this is a mess. This is not accurate. This is not correct. And the funny thing was, as I was studying the numbers themselves, and I looked at how they modified the numbers, which they're very public about, how the fact that they fiddle with the numbers all the time, so that from one period to next, you can't compare the numbers because they're different numbers. The methodology itself, the math changes, the formulas change. But beyond that, when a lot of studies that people were doing about living wages and employment over time weren't agreeing with the government numbers, people who had done independent studies, tons of reporters and analysts have been doing this. And so the public was basically calling out the government back then. And now I think we see what happens when you fiddle enough. You fiddle enough, nobody believes anything. I don't believe the employment numbers for 5 seconds. A couple of things they've done in the last 2 years, which are very alarming. 3 times now, 3 within the last year and about 3 months. They have changed their entire methodology for calculating employment, the entire base methodology, and they've tried to reset the numbers dating back years, like not just the current quarter or month report, but years. And they're still not matching up with the methodology they say used 20 and 30 years ago. So what they keep screwing things up more. And one of the results of that is the over complication of counting and the ridiculous schemes that they use to make things appear the way that they need to appear has led to numbers that are just false. And so now you get these big seasonal adjustments that, well, it was 339,000 jobs created. Oh, 373,000. Oh, I'm sorry, it's 229. Well, right. Okay. Well, how are you off 150? And then a month or two later, you come back and say, well, we were off by 35%. How does that happen?
We're supposed to believe all of that.
Yeah. And the other thing is their sampling methodology is horrible. It's a sampling methodology, which is not accurate. I mean, it's very low tech. It doesn't do a good job. The way they're calculating the numbers is wrong. The adjustments they make on the backside to try to account for all these weaknesses in their methodology. And it's an old methodology. It needs to be retired. It's just not effective. And so the numbers are way off. And that's why you can have an inflation number and people look at that and say, my food's going up more than that inflation says.
Right.
Or I can't find a job. You're telling me you're creating jobs all the time. I can find no jobs. I can find a part-time job at McDonald's. Those are the types of things that people are seeing. And whatever the numbers say, they're seeing something different. And that's because the numbers have just been fiddled with too much. The methodology itself is completely broken and it needs to be reset. And that's why, you have to be careful watching the government numbers. It's a lot of it, there are a lot of good people that work in government, but it's gotten to the point of where it's mismanagement and ineffectiveness and incompetence, and it needs to be redone.
Yeah. So staying on the unemployment theme for a moment here, do you see a mass unemployment event coming with the next economic challenge? Or do you believe that the demographics are such that we could experience a poor economy and dropping markets and some chaos, but yet jobs would remain relatively stable?
Well, jobs right now, if you look at the jobs that we're creating just right now, prior to the big one, whatever the big one's going to be, jobs right now are mostly part-time with no benefits, and they're not keeping up with inflation. Wage rates overall are not keeping up with inflation. But when you lose a good paying full-time job with benefits and you go to a part-time job with no benefits, not only have you cut your rate, you cut your hours, okay, but you've also cut the side things that you get when you work for, because remember, in corporate America, in the system we work in, it's a quasi-socialist system, quasi-capitalist socialist system in which the jobs provide the benefits. It's an element of socialism baked into our cake. And when you lose that, all of a sudden you're not part of that system. You lose all those extra benefits. And so the overall standard of living for people is coming way down, way beyond just the differences in wages and the differences in hours that they worked. And that's a sign that the system can no longer support the wages that they were at, given the amount of debt that we have in the system. And so with the debt correction comes one of the largest costs of any company is labor. And they're only going to be able to cut commodities so much. They're only going to be able to cut equipment so much. But the first thing that they cut when you run into real problems is labor. They cut labor first. And so what's going to happen is I think there's going to be big labor events. I think there's going to be a lot of unemployment. Now, a lot of that will heal itself. Eventually, as the system works through the challenges, more entrepreneurism will show up. We'll have more job creation. More jobs are created through small business than they are through large anyway. Too many of us were working for large companies. That always had to come to an end, especially as those companies and their products age and they have too much debt. So in some ways, it'll be good. You can retrain. You can do other things that will put you into better careers and things. But yes, during every major economic challenge that we've had in our history, we've had unemployment issues. So I fully expect that to occur.